Moving iron.
Hello and welcome to Moving Iron Podcast. I got Tanner Ehmke back here with me from CoBank, and this edition of the Moving Iron Podcast is brought to you by AgDirect. Tanner is with CoBank, and he's part of the Knowledge Exchange Group, and he is primarily focused on the grains part of what's going on there. So, Tanner, how you doing, man?
I'm doing all right, Casey. Glad to be back.
Okay, I'm glad to have you back, man. So, you and I have been doing this for a long time now, having these podcasts, and we've really never had anything where we had to scratch our head to think about what we were going to talk about. And this week's no real different. This time around, it's not really different than what we've seen in the past. So there's a lot of stuff going on geopolitically, so Russia kind of, blowing up the dam that they saw, was flooded the MIP River, kind of went down into Kherson and what they have done there. And then if you look at how that's playing out in the geopolitical side of things, that's pretty much a sign of desperation on their part, and they're doing a bunch of kind of throwing their hands up in the air about the Black Sea agreement that they've agreed on about 4 weeks ago about that we're going to do this for another 60 days or so, and that quickly dissolved pretty fast. So I guess geopolitically speaking, throw China in the mix there too. What they're buying a lot from Brazil, not a lot from us, but they're firing up of their economies not quite as fast as what people had expected or thought it should be compared to what we saw in the United States. So I guess from a geopolitical thought process right now, as you take a look at what's going on in the overall economy of the ag world there, Tanner, what's your thoughts and how are you kind of thinking through some of these things?
Well, let's first of all just take a look at what's going on with global prices and with where the U.S. compares globally, and we're still trading at a premium to everybody else. We've got a few things going on there for corn, wheat, and beans. You'd mentioned what's going on over in Ukraine and Russia with the whole dam explosion, and that there were some concerns there that that was going to send more export demand back to the U.S., especially for corn and wheat, because of the geopolitical concerns there that that was Russia sabotaging not only Ukraine's agricultural production in that part of the country, but also signaling there also that they're not going to be continuing the Black Sea grain initiative because of they're in a war, and in the fog of war, these things are hard to figure out. But really, that really complicated things. So when you look at U.S. wheat prices, we're still at a very large premium to the Black Sea region. And that's because we've got a big drought in this country. And so the market is trying to prevent those bushels from leaving the U.S. But at the same time, Russia is still moving record large amounts of wheat onto the global market. And so that's important because Russia is the price setter in the world wheat market. And we're trading at a major premium to Russia. So I think that's one dynamic we need to continue to remind ourselves of, is that whatever's happening geopolitically, Russia has been exporting record large amounts of wheat, with the aid of also Australia. They had a record wheat crop again this year, and they've been they had been exporting a fair amount over this past year as well. So whatever is going on geopolitically, we're going to have those geopolitical scares, but because we've got so much exportable surplus coming from major exporters like Russia and Australia, that dampens that fear of scarcity. If you take out those two countries, things get pretty tight pretty quick. And we've got a lot of things right now to be concerned about, specifically for wheat. And I'll talk about corn and beans here in a moment. But we've got drought here in this country, and we're going to have a very small harvest in the U.S. We've got drought up in Canada. They're a major exporter. We are now experiencing dry conditions across much of Europe. It's getting concerningly dry across much of Ukraine and central Russia in their crop growing regions. So these things this abundance is starting to become more concerning now, where we could quickly start to see a situation where global stocks in the next crop year get very tight, at which point the U.S. is going to have to become a lot higher on our prices to stop the flow of exports into a very tight global export market. Same thing with corn. We've seen phenomenal exports, not out of Russia though, but it's been coming out of Brazil. And Brazil's prices are far below the United States. And so when you have that export bid so far below the U.S., that kind of dampens any enthusiasm there might be behind any of these geopolitical stressors. But remember, we're only one crop away from a disaster, and that's why we're looking at what's going on in the U.S. with how dry it's getting. And it's starting to get a little dry out there across much of the Midwest. We've seen it very dry for a long time on the plains. That drought is now spreading east into the Corn Belt, and it's still early out of the season. Here we are, call it around mid-June. By the time July rolls around and we have not had any substantial rains, things are going to get a little concerning for the corn balance sheet for the U.S. and for the world. And so, again, all of these things are kind of on the back burner as long as we have these major exporters like Brazil and Russia moving lots of commodities into the global marketplace. As soon as that abundance starts to shrink and we start to see some smaller crops with other major exporters like the U.S., things can get pretty scary pretty quickly. It doesn't take much. And once we start getting into, like I said, the critical month of July, things are going to get really volatile if we have not had a rain in the Midwest between now and then. And then same thing with soybeans. Again, Brazil, they've been moving record tonnages out into the world export market. China's been taking a huge amount of that. Same thing there with corn. And that explains why we've had so many cancellations from the Chinese. A lot of people are trying to tie this to the geopolitics of what's going on with Russia and China's support of Russia. That's not it at all. It has to do with price always. It's always price. And the Chinese found much lower prices down in Brazil. And so they canceled their U.S. orders and switched them to Brazilian origin. So that's really what has been pressuring us in the commodities and the ag commodities over the last several weeks. And then add into this the speculative selling that we've seen. Now, here in the last week, speculators have been net buyers. They started adding length in across the ag commodity complex. But if you go back to the last several weeks, what have the funds been doing? They've been selling. And why did they sell? Well, they no longer see inflation as that threat as it used to be. And we can talk about the CPI numbers that came out today. Inflation has been coming down. And if you're a money manager and you're looking at the erosion of the value of your investments every day because of inflation, what do? You got to hedge against that. And how do you hedge? Well, you go out and buy commodities. Well, inflation has been slowing. And so we've seen over the last several weeks managed money paring back their net long positions in agricultural commodities. And that has been adding further downward pressure. Now, all it takes is a major weather scare and perhaps another geopolitical disruption. We going back to the Black Sea grain deal. Let's say that gets undone and there's more grain stranded in Ukraine. Now the world balance sheet tightens a little bit. It stays dry in the U.S. It gets tightened a lot more. And now you have a bull market forming very quickly. And so the managed money is looking at this and saying perhaps they don't want to be on the wrong side of that trade. And so now here recently they started going net long again. So a lot of things there moving in the background of this global export, enhanced global export pace from our competitors in Russia and China. They have been covering up, if you will, a lot of these geopolitical concerns because they have so much supply. But once that supply goes down, you're gonna see a lot more volatility. And I think going around the world, and you look at the dry conditions across Europe, Russia, Ukraine, the United States. You look at rising global usage. You could see a picture unfold fairly quickly where we'd see a lot more volatility.
Yeah, yeah, that's so I'm glad you brought that up, because if you take a look at like India, for example, and where they've been at for the last 7 years, they've had just an incredible amount of crops they've been able to produce: sugar, rice, wheat, whatever. I mean, anything they've cotton, whatever they can produce, they just had incredibly. We're starting to see some slide back on what they have as far as their crop production goes now, just because of weather conditions. So
exactly.
So Brazil's got an opportunity to really come out here and make a quick sprint out to the front. But like you said, once those, sooner or later, Brazilians are going to step back and say, all right, cool, we need to keep some of this for ourselves now. And it's just not going to be readily available for what we see happen there. And like you said, if we do continue down this drought pattern that we're seeing right now, it's going to play a big effect on the overall market, especially just because, like you said, we're one crop away from having a disaster, and things are kind of pointing in that direction right now. I don't want to be the Chicken Little here, the sky's falling, but there is definitely the opportunity right now that we're seeing for things to gear up into that, because even the places that are dry right now a lot of places didn't have the subsoil moisture to offset being dry. They're going into dry soil conditions, into drier weather patterns, and it's wreaking havoc on what we see out there right now.
Yeah, the number I usually look at is the global stocks to use ratio, and right now, corn stocks to use is coming up just a touch. If we have any problems that develop where we have a much lower, or we have yields that are below trend line, that'll pull our global stocks to use ratio down even lower to even more historical levels. So the world needs the United States to come out with a big crop like the USDA is currently forecasting. But if these dry conditions continue, the market is going to start redoing the math and saying, wait a minute, we're not going to have the surpluses there that we need, given the expanded usage for commodities this year. So things could change pretty quickly. And, I forgot to mention El Nino. Okay. One thing there is that is not good news for another major exporter, and that is Australia. El Nino turns hot and dry for Australia. And I remember back several years ago, they had several years or a few years back to back of El Nino. And it was just very depressing times in Australia, where they had very small crops back to back to back. And the world balance sheet got pretty tight, and some pretty volatile times. So we got to keep an eye on what happens there with El Nino. Now, El Nino is supposed to be positive for rainfall for much of the U.S. We're clearly not seeing that right now in the Midwest. We're seeing it out further west, where I am in Colorado. It's been raining constantly. It's been raining every day now for a little while, and so, but we're not a major corn, wheat, or soybean producer. We do produce wheat in eastern Colorado, but it's not going to be enough to move the balance sheet. So anyway, those are, a lot of these things currently are in a position where the world is depending upon these exportable surpluses out of Brazil and Russia to keep prices down. But once those surpluses are depleted, now we have a reckoning of what is the production potential following those crops, and we can end up in a tight situation.
Yep. Okay, so another thing, let's talk a little bit about this from your perspective. As you look around, you take a look at interest rates and what they're doing to on-farm income and servicing debt and those kind of things, and start looking at lines of credit that are being issued out there, operating capital, and those kind of things being issued out there. What does that look like? You take a look at where we are from 2022 going into 23. The on-farm income, so I think a lot of that kind of got deferred over into 23 a little bit as far as capital goes. It hasn't slowed down the sale of equipment yet, but that's creeping into the conversation more and more. I guess as you take a look at what you're doing there, and then some of the folks like Ken Zuckerberg that are tracking that farm supply, what does that look like, and those things out there as far as inputs go. I guess when you're looking at that in the conversation you're having with your counterparts at CoBank, how is interest creeping into the conversation, and are you starting to see a slowing of the ag economy because of it?
Well, it's obviously going to slow down the entire economy. That's the intent.
Sure.
To slow down borrowing, and it's going to be hard for some people out there who have to borrow. Let's say in the grain trade, we just came out with a paper here recently on the cost of carry, and it's going to be record high this year. Well, you can't not borrow against that inventory, and so your cost of carry is going to be elevated, and that's going to be widening basis in a lot of areas, depending upon an elevator's debt structure. But to the larger farm economy, you would have to imagine that it will slow down land purchases, machinery purchases, things like that, and cause farmers to delay purchases till some other day where they don't have to borrow as much. This is also in a year where we're seeing net farm income come down from last year's record high. We had record high commodity prices last year. Right now, we're seeing that catch up. Commodity prices have come back a bit, whereas cost of production has remained fairly elevated. And so what that means then is we're going to see net farm income come down this year, and then at the same time at an elevated borrowing cost. Well, what that means then is you're going to have a farmer there who's got less cash to buy inputs or to buy machinery or to buy land or to chase cash rents. And at the same time, the cost of taking out debt is going to be coming at a higher cost as well. And so there's a lot of the wind is going to be taken out of the sails of a lot of farmers and ranchers compared to last year. Now, you'd mentioned there's some carryover income, and that's absolutely true. You and I were talking earlier about how machinery sales have remained very strong based on the latest data. And that's all being driven from money that was made last year. Farmers are they paid down debt. They still got cash in the bank. They still have ability right now to buy land and to buy machinery and to perhaps chase cash rents higher. I would imagine, and this is what I think a lot of other economists are expecting, that tailwind is going to go away. It's not going to disappear necessarily. I mean, if you're in an area where you have higher yields, that's great. I mean, you're going to be able to make it through another great year. But if you're in an area where your yields are a lot lower because of drought and commodity prices have not come back, not returned to the levels they were previously, well, then that's going to be taking money out, or that's going to be shrinking your cash flow compared to what you saw last year. And so farmers are going to have to become more conservative. So I would imagine, generally speaking, across the ag economy, we're going to see a slowdown based on that dual impact of lower commodity prices, higher input costs, higher production costs, and higher borrowing costs.
Yep, for sure. Yeah, I think 24 is going to be a lot different picture than what we saw in 23, just as things kind of settle in and settle out, depending on what happens with commodity prices and those kind of things. But like you said earlier, bushels are what can make things happen, not so much and you make it up on the marketing side of that. So that's
yeah, bushels pay the bills. You can manage the marketing plan, but you don't have bushels to sell. It doesn't matter what the price of corn is. You got to have bushels.
Hard to get someone to pay for bushels you don't have. That's for sure. For sure. All right, Tanner, good stuff as usual. If folks want to reach out to you and get more information about what you're doing over at CoBank, what's the best way to do that?
I think it's funds@cobank.com, COBANK.com.
Right on. And you're out on Twitter at Tanner Ehmke? Is that? Or you have
that is correct. At Tanner Ehmke, TANNEREHMKE on Twitter. I think I'm the same on LinkedIn.
Yeah, I think you're right. So, all All right, good stuff out there. The folks from CoBank, there's a lot of great information out there on their website for free and good stuff. Go check that out. And then also check out what those guys post out there on the Twitterverse as well as LinkedIn, because again, a lot of good stuff comes up there. So Tanner, I appreciate you being on the podcast, man.
Glad to be back. Thanks for having me, Casey.
All right, man. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC, LinkedIn at Moving Iron Podcast, and go over to see the video version of this at the YouTube channel, which is the Moving Iron Podcast YouTube channel. Go to LinkedIn. Sorry, I said that. Go to Moving Iron Podcast webpage, which is MovingIronLLC.com. You get all the information from Moving Iron Summit coming up here in Nashville, Tennessee, September 11th through the 13th. Check the 11th through the 13th in Nashville, Tennessee, and you'll get all the information there as well. So with that, I'm Casey Seymour with Tanner Ehmke. Let's go smart, folks. Out.
Moving iron in the 21st century.